helps you make a lot more money. Okay, so when we think, if we look at this, we say, well, really, if we're going to be good investors, what we want to focus on is what's our asset allocation, right? Here's another way to look at that. This is a slide of risk and return. It shows us risk and return. If we look here, this is low return, low risk. Out here is high risk, and out here is high return. So if I'm at the bottom here, I'm in low risk, low return. Here I'm in high risk, high return. This little dot down here is all bonds. This is the period 1970 to 2005. So this is 100% bonds. And so what I would say, if I wrote a narrative about where that dot is on the chart, what would I say relative to risk and return? Stable. Low return, low risk, right? Okay, what if I wrote one at the top, this little thing here is stocks. What if I wrote a sentence about that? What would I say? High risk, high return. Okay. So if you think about it, if you had a portfolio of all bonds and you added stocks, do you think you would have more or less risk?
Depends on your age.
If you added stocks to your bond portfolio, depend on your age. So you have all bonds and you're going to add some stocks. You're going to have more or less risk. More? Well, actually, you have less. Because they're not correlated. It's that correlation thing. Here, if you take all bonds and you add 25% stocks, that's where this dot is. And where is that dot? We're going down in risk, and we're going up in return. So you actually have, if you have 25% stocks and 75% bonds, you have a portfolio that's less risky than 100% bonds. It's kind of counterintuitive, isn't it? And you know what this little dot is? You can't read those numbers very well, I don't think. That's 50-50. So if you have half bonds and half stocks, your portfolio is equally volatile to a 100% bond portfolio, but you have what? More return to show for it. So it's kind of counterintuitive. We think, well, I'm going to add risky things to my non-risky portfolio. Do I get more risk? You actually get less risk. But we can actually, and if you get to the 50-50 point, you can have the same amount of risk and more return, which is where we'd all like to be, right? So here's another way to look at that. Let's say I'm retired, and I'm fortunate enough to retire in 1973. Remember that in 1973 we had the graph? Of course, the market's going down like crazy in the beginning of my retirement. I retire with $1 million, and I have a 4, a 5, a 6, and a 7% withdrawal rate. That yellow line, the one at the top that keeps eventually gets way up there, that's 5%. So if I take 5% of my portfolio, I never run out of money. The pink line is 6%, and I run out of money at 6% at 30 years. And this is invested in the S&P 500, so I have all stocks. Okay. The blue line, which is 7%, I run out of money in 16 years. So now most of us, when we think of investing, we want to maximize what? Return. And if we look at the return of stocks to bonds, which has the highest return? Stocks. Okay. So if I'm saying I'm going to retire, I want to have the maximum return, I'm going to just buy stocks. You would think that my money would last longer, right? I'm going to have a higher return, my money will last longer if I have all stocks. Well, do you think that works? No. Actually, it doesn't work. Here's a slide that shows exactly it not working. It's the same $1 million, only this time instead of investing in the S&P, I put 60% of my money in equities and 40% of my money in bonds. Now, if I'm going to buy 40% bonds, I'm going to think my return's going to go down, right? But I'm withdrawing from my portfolio. So at 5%, again, I never run out of money. You actually end up with a little bit more than you did with a stock portfolio. The pink line, which was the 6%, remember we ran out of money in 30 years in the old, if we had just stocks? We can actually withdraw 6% and never run out of money if we're willing to take and have 40% bonds and 60% stocks. And the blue line lasts 20 years instead of 16 at 7%. So if we have to look at the volatility in the portfolio and withdrawal rate and match the two together. How do we manage that? So return by itself, that's why the planning process is important. Return by itself isn't the answer. We can be generating the maximum return. The question is, are we going to outlive our money? It's more important than what's my return. So when looking at that number of my return is interesting, but what is it that I do to invest my money so I never run out of money? It might be that you lower your return slightly. Because if you have less volatility withdrawing your assets, it could last longer. So, any questions? I've either bored you to death or something. So, this is a slide that's set up the same way as the other slide. The bottom graph is risk. So if I'm over here, I'm at low risk, and if I'm up here, I'm at high risk. And this is return. This is low return, and this is high return. Okay? So everything over here is high risk, low return, and this is high return, low risk. Are y'all with me on that? That makes sense? So there's just dots up there, and they don't have answers, but I'm going to ask you to choose. Let's see. Everybody see the blue squares? You see where the blue squares are? Over here? Okay. Y'all see them now? Okay. Do you see the green triangles? Okay. So what would you say about the green triangles compared to the blue squares in terms of risk and return? Or you get more return or less return with the green triangles? More. Do you get more or less risk? Less. So if you had a choice in investing between the blue squares and the green triangles, what would you probably choose? You choose the green triangles, right? Okay. So does everybody see some orange diamonds? Right here. See those? Where are the orange diamonds compared to the green triangles? More or less risk? Less. More or less return? More. And then there's that one circle up there, at the very top, up there near the diamonds. Okay, so what is all these squares that Mackey just, shapes that Mackey just made me look at? Well, there are different asset classes. The blue, this is looking at the real estate market, Chris, which is one of your questions, the real estate market, the commodity market, the S&P, and the international index. And each of those blue dots is just one. Okay, so let's look and see where they are. This blue dot is the commodity index, and this blue dot is the international index. This is the S&P, and this is real estate. So that's saying I just want to buy real estate, or I just want to buy the S&P, or I just want to buy commodities. In the greens, the green people said, the green triangle said, I think I want to own two asset classes. I want to own maybe real estate and the S&P. Or I want to own internationals and real estate. Any two things up there. And I'm going to rebalance to that. So if I own any two versus any one thing, I'm raising my return and lowering my risk, right? And the diamonds are, you probably guessed it by now, what? Any three of those things, right? So if I own a third internationals, a third S&P 500, and a third commodities, or I own any three of them and I rebalance, again, I'm diversifying my asset classes and I'm getting less risk and more return. And the circle is all four. Yes, Greg?
But that's just not asset class. That'd be like circle be 25, 25, 25, 25.
It's 25, 25, 25. It's setting an asset allocation policy and rebalancing to it, which we're going to look at in a second. It's a very good point. It's not just a willy-nillying. You know, one of the things that we're going to talk about is having an asset allocation plan is how you use the volatility of the markets to make money with it. Okay? Does everybody see the results? Make sense? Kind of counterintuitive? So what if I said I want to have an asset allocation plan? So having an asset allocation plan means that I decide before I start investing how much of my money is going to be in stocks, how much of my money is going to be in bonds, real estate, commodities. What is my asset allocation plan? And what I'm going to do when I have the plan is the operative word there. I'm going to rebalance to that plan. So this is just a really simple example of I have a plan that's 50% stocks and 50% bonds. You know, it's not any more complicated than that. And we're just going to look at this as an example to see how it would work. So if I decided that my asset allocation plan is half stocks and half bonds, remember that was the point on the graph where I had if you said just bonds versus 50-50 stocks and bonds, I was making more return taking the same amount of risk as the bonds. Do you remember that? Okay, so if I said, well, that's good enough for